So, four concepts you want to think about when you are looking at multifamily properties. The first is appreciation. Appreciation is the increase in value over time. Essentially, if you purchase something at 500,000, over time the property is going to appreciate. It's going to start at 500,000. Usually at least keeps pace with the rate of inflation, which is, like I said, been 4, 5, 6%. So appreciation is the increase in value over time. It affects not only the value of the property, but also your rents. If you start off with a 3-bedroom apartment in 2014 at $1,500, it's not going to stay there. Over time, rents are going to increase as well. As new people move into Boston, as the supply shortens, and as demand increases, rental values are going to go up. Cash flow. Cash flow is basically your income minus expenses, what's left over. Cash flow can be either positive or negative. Ideally, if you're investing in multifamily, you would want to be positive. Perfect example of cash flow is this little diagram that we have over here. If you have a 3-family, you're collecting $1,600 per unit. Unit 1, Unit 2, Unit 3. Each are relatively 3 bedrooms in Dorchester right now. $1,600 a unit. You're collecting $4,800 a month in rental income. If you have a mortgage of $1,900, if you have taxes of 5, insurance of 3, management costs of 4. Management costs would be something you may or may not have depending on whether you live in the building, whether you manage it yourself. That number may or may not be there. Water for a typical 3-family is about $200. Repairs can, depending on the condition of the building, can range from nothing to a few $1,000s a month. Ideally, like I said, if you're buying something at the $500K mark in its current, in our current market, you're probably buying something in relatively good condition. I would say if you're putting $500 back into the building every month, you're probably, probably in a pretty good position. If not going into the building, it's going into your reserve account. With your current expenses or your total expenses, you're looking at about $3,800 a month. Cash flow is simply explained by the income of $4,800 a month, 16 times 3, minus your expenses of $3,800 a month. Cash flow, you are putting $1,000 a month back into your pocket. It's one of the biggest things that real estate investors look at when they are evaluating multifamily real estate. Debt pay down, another very simple concept. In this model, with the investor I was speaking with, he had $100,000 to invest. He was buying or looking at properties at roughly $500,000. His debt or the amount he's financing is roughly $400,000. So 5 purchase price, down payment $100,000. His financing amount is $400,000. Debt pay down is simply over time the money that you're collecting. 16, 16, 16, 4,800. Your major expense is your mortgage of roughly $1,900 is what we calculated on today's interest rates, assuming that he was financing about $400,000. He has a $1,900 a month mortgage. A good percentage of that $1,900 in the first year, or first few years, is going to be interest. But over time, a lot of that money is going to be put towards principal, and the debt is paid down. If you look at appreciation and debt pay down together, that's what this chart is down here. The scales: year 1, year 2, year 3, year 4, year 5, time scale. He's starting with a value or initial purchase price, assuming that we purchased the property for its fair market value of $500,000. He's starting with initial debt of $400,000. His initial equity spread is that $100,000 down payment that he put in. Value is at 5, the debt is at 4. Over time, if you take your concept of appreciation up top, 5 years, the value is going to go up. Over time, debt is going to get paid down. If you take that and you assume that these numbers are right, and over 5 years he's able to pay down $100,000 in debt, the property is appreciated at $100,000 to $600,000. He initially started with a $100,000 equity spread, and now in 5 years has created a $300,000 equity spread, or has increased his net worth by $200,000. He started off with $100,000, and now the portfolio, or if that individual property, he has a equity spread or a net worth within that individual property of $300,000 just by his tenants paying down his rent. That does not include the cash flow that he is actually getting from the property. But we'll talk about that in return on investment. So if you take appreciation, debt pay down, you can figure this model out. It's how do I figure out what a property is worth 5 years from now? It's just not a random guess. I can take what's called the compounding calculator. You can go to Google and find relatively easy, just Google compounding calculator. And what the compounding calculator does is basically says at 500,000, if I assumed a appreciation rate or a market appreciation rate, if we're going to go conservative, we can basically say, let's say a 2.5% appreciation over 5 years. What am I going to end up with at the end of 5 years? This is not equivalent to this. I think this is a much higher appreciation rate over 5 years. I think 600 is where you'd be at after 10 with a 2.5. This is closer to a 5 or 6% appreciation rate at this rate. You can assume 2.5% is conservative. I think that's a very safe number to assume if you were going to punch something into the calculator. So again, compounding calculator will tell you where you're going to be at a future date. If you want to find out where you're going to be in terms of debt pay down at a future date, you can use what's called an amortization calculator. Amortization calculator. You can Google one of those as well. And basically what the amortization calculator tells you is I owe $400,000 today. I'm at a 5% interest rate. As I pay down, assuming that I do not pay anything extra and I make all my payments on time, where will I be at year 1, 2, 3, 4, 5, and so on. It'll basically amortize all the way down into a 30-year mortgage. The word amortization just basically means the systematic pay down of debt over time. So basically what I did, use my compounding calculator, figured out where I was going to be in 5 years, use my amortization calculator, figure out where I'm going to be in 5 years, and you can figure out, okay, if I hold this property from today, 5 years, 10 years, where am I going to be financially at any given point? It's one of the reasons that real estate is such a valuable asset is because of not only appreciation but debt pay down. Stocks appreciate. If you buy a stock at, if you buy $1,000 worth of Apple stock, the value may go up and it may go down. You can have $2,000 worth of Apple stock based on that $1,000 investment in 5 years, or you can have your portfolio be at zero. With real estate, you'll never have an asset worth zero. Real estate does fluctuate, but not as wildly as stocks. And like I said, it'll always be at least worth its rental value. So last concept, return on investment. My initial investment was $100,000. Your investment is the money that comes out of your pocket, not what you purchased the property for. I purchased the property for $500,000. That was the value of the property, but my initial investment, what I put into the property, was only $100,000. In this particular model, he put $100,000 down. Excuse me, put $100,000 down. His cash flow, assuming everything went well, no major vacancies, no major expenses. The $500,000 he purchased the property for was relatively, the property was in relatively good condition. This model was followed pretty well. He ended up with $1,000 per month in cash flow. You take $1,000 per month, multiply it by 12 months, you have a $12,000 in cash flow per year. You spent $100,000, you bought the property. Again, this does not include your appreciation or your debt pay down, but you put $12,000 back into your pocket at the end of the year. $100,000, you receive $12,000 back. It's a simple 12% return on investment. Again, not everyone has $100,000 to put down. If you went into this particular property with an FHA loan, you're going to have two different, it's going to be a different scenario. But if you, let's say if you went into this property with an FHA loan, it's assuming that you live there. You're basically going to have a 3.5% down payment on your FHA. You can get into the same exact model with a lot less than $100,000 down. It was roughly $15,000. Not really sure what the exact number is, but the only difference is when you come back over here, you're probably going to be living in Unit 1 and not collecting rent there. If you're living in Unit 1, you got to cross off and you're going to remove that $1,600 in income. Now you have $3,200 in income instead of your $48,000. You took away $1,600. You only have the income coming from Units 2 and 3, so you have $3,200 in income. Your mortgage payment is going to go up. Remember, he put $100,000 down. You're only putting 3.5% down. The mortgage payment is going to go up. Let's say mortgage payment went up to roughly $2,500. So now you have, this is going to go up $600. Expenses of roughly $44. And again, this is assuming that you live there, but you're still having somebody else manage it. You can actually, if you wanted to, what you can do is you say, okay, I'm going to sweep down my own steps. I'm going to shovel my own snow, get rid of this cost as well. And now you reduce it again by $400, and you have a $4,000 mortgage payment now. If you change these numbers again, to income of 32 and expenses of 4,000, that means you live in your apartment or you live in Unit 1 for $800 a month essentially. So to go back through that one more time, let's assume that we're not an investor. Let's assume we're an investor, but we're going to say we're going to own and occupy the property for a little while. We're going to go in with a minimum down payment. This could be, FHA. It could be conventional conventional loan of, I should say, 5%. It's still in, relatively low down payment, so you can get in for a lot less than $100 grand. I'm going to live in Unit 1. I'm going to remove the $1,600 because now I live in that unit. I'm only collecting $3,200 now from the 2 units. My mortgage payment is now increased to about $2,500. I still pay the same taxes, the same insurance, the same water bill. I'm still putting $500 back into the property every month or into my reserve account. So is that right? 25, 3, 4,000 is my total expenses, minus the $3,200 that I'm getting from the other 2 units. I basically live in the 3-bedroom apartment that everybody else is paying $1,600 for $800, but I'm also getting the appreciation from the property, getting the debt pay down from the property as well. So, multifamilies, basically, approaching it a few different ways. Last thing is if you wanted to figure out, okay, what do I owe? Most of the time you can figure out what the taxes are from the MLS sheet. The insurance for, this will leave you about, $3,600 a year. That's probably actually a little high, but I would say insurance for most of the 3 families at this rate are about $3,000 a year. So you can probably reduce that a little bit. Water's about $200 a month. Repairs, you can, like I said, dictate that how you want. But if you want to figure out what your mortgage is, you can just basically Google mortgage calculator, and you want to Google mortgage calculator and then say national rates or interest rates for loans and see what comes up. Basically, if you want to be on the safe side, if the national average mortgage rate pops up to be 4.25, maybe you assume, I know my credit's not that great, I know, like I said, I'm going to have some other issues, maybe you assume 4.75, and then you go see your mortgage calculator and basically say, hey, I'm looking at properties at $500,000, I'm going to go FHA, I'm going to put $15,000 down. I know that means I'm going to have to finance $485. If I finance $485 at 4.75% rate of interest over 30 years equals a mortgage payment of X. And that's really what you're trying to get down to is what is that what does that number work for you? And then you can say, well, if that's too high or I don't want to pay that, then you say, well, can you put more money down? Can you come up with a 5% down payment or more? Or maybe you have something, maybe you have a 10% down payment or whatever it may be. The last thing that you want to consider when you're investing in multis is I don't want to live with people above me or below me forever. That's terrific. You don't really have to. If you're thinking, hey, I want the suburban life, I want the single family life, but I know that I want to, get in an investment property, this is not a permanent situation. Basically, if you can get in, and let's say, for instance, you live in the neighborhood right now and you're paying $1,600 a month for rent, right? This is the market you're renting. You're paying $1,600 a month. That's not going to anything. You're not saving that money. It's not an investment for you. You're not seeing a return on it. You're paying what the market rate is of $1,600. If you're able to save something on the side, you can get to that $15,000 down payment FHA loan. Get yourself into this this particular situation. You follow this model exactly, and if you did, you're going to move out of your apartment, and now you're going to move into this 3-family, and you're only paying $800 a month for a very similar apartment. Move to the other side of town. You were paying $1,600, now you're paying $800. You can now save $800 a month towards your new down payment. If you were able to do it while paying $1,600 a month, you should be able to do it relatively easy. If now you're only paying $800 a month, you save this, you have a new down payment, you wait a couple years, you save some money, and now you go back to your mortgage broker and you say, now is the time for me to go get the single family that I want in the burbs. Two things happen. He's going to say, okay, yes, let's go get you the single family, but you also are now renting out your third unit, or your first unit, your first floor unit, your third unit. The unit that replaces, the tenant is now going to replace you, and you're going to go back to the similar model where you're now collecting $4,800 again. If your expenses are still the same of $4,000, now this is a positive $800 into your pocket. Again, 16, 16, 16 is $4,800 a month. Your mortgage hasn't stayed the same since you moved into this single family. It stays the same since you moved into this single family. All your expenses are the same. Again, management is something you have to kind of decide on your own whether you want to do. But now your income is $4,800 again. Your expenses are still $4,000. Now you have a positive $800 that's also going to help you with your single family monthly payment. So you were able to save $800 a month here, get your down payment or help you with your down payment. Now you own a single family and you have essentially $800 coming from that property, which you can either do one of two things. If you can afford this on your own, that's great. You can take that extra $800, again, save that or dump it back into the property, make some improvements or make some repairs to that property, or take that $800 and help fund your life in the burbs. But at least now you have your home here and an investment property, which is going to help you fund your retirement for the future.